All right. Solomon's joining. I'll give it just a minute.
Oh, we got Trent on. Nice. Adam, Jeff. What's up?
Yeah.
We got some franchise people on here. Do we have any Cutco people on here, Justin? You probably have Cutco people on here, don't you?
We have at least 2 Cutco people that I've seen, although now I'm looking at it in review. So let me just change this up and see.
I'm trying to mute people. So if you are on here, this is not a webinar format. This is just like a Zoom meeting. So go ahead and mute yourself unless you want me or Justin to make a lot of fun of you. Like I was hoping I could do to Chris Elmore here, but he's probably going on mute before I can.
Good to see you, Chris. I think last time I saw you was on the volleyball court in the Black Hills.
That's right. I thought we had another cranberry, but
Oh, we got Joe on here. Good to have Joe Scavo. That's awesome. And Joe Cox.
I was just on with Joe Cox yesterday.
I love it.
Yeah, this is fun. It's fun seeing our worlds collide. You know, that's what happened out in South Dakota at the Shindig. It's like the worlds collided and they're doing it here. It's so fun.
That's right. And Stuart, I'm so excited to connect with you. Hans just says so many nice things. So good to have you on. That's awesome.
Dude, Hans probably didn't just say nice things, but Hans just dropped some serious knowledge in the mastermind session, talking about some stuff that he's an expert with. I took some notes on that.
He crushed it. We got Brandon on here. What's up, Brandon? You're looking fly in that suit. That's a nice background. I like that. We got Matt King on. What's up, Matt? Chris Naku, Amber Hoffman. Fun. This is going to be a great session. I'm excited to hang with everyone.
Well, let's get going, man. You ready?
Yeah. Oh, I'm totally ready.
All right. So what we wanted to do, some of you guys have been good friends of one of us or both of us for a while. And some of you have been inquired about the mastermind, applied. Most of you have applied for the mastermind. And we wanted to give you a taste of what a mastermind session would be like. And so that's really kind of the purpose of this. Now, mastermind sessions can last, 2 to 4 hours, depending, and it's typically monthly plus extra calls, depending on different things. And then we have a community inside a program called Circle where we upload everything and everything's uploaded. So you can go back and review all kinds of past stuff and conversations. And it's a great place to have conversations. You get access to all the recordings and whatnot. So you don't have access to any of that stuff. And so we wanted to give you a sample of what a mastermind session might look like. Because I hear all the time in these sessions from members, and one of the things that I hear so often in private conversations, talking to somebody the other day, is like, Eric, I have had a lot of money. This is me paraphrasing. I've had a lot of money. I've made a lot of money. I've kept a lot of money. I've invested a lot of money, but I had no idea the things that I was missing in terms of the investment opportunities, the tax saving strategies. And it's like the wealthy have access to a lot more than just the normal average citizen, but the ultra wealthy have access to way more than just your average wealthy person. And so it's fun seeing people just have these massive aha moments of these strategies that they just never knew were really available to the average person. So Justin, I wanted to do this. I'd like to just jump into it, Justin, if you're good with that. I have some questions for you.
Sure. Yeah, let's jump in. I'm excited. I'm just thrilled to be able to share, some of the things I'm paying attention to. I kind of geek out on, paying attention to what's going on in the economy and just opportunities that maybe few people know about. I call them invisible deals, just cool arbitrage opportunities. But I think in order to find those, we have to really understand what's going on. And a good deal last month is not a good deal this month if you understand what's happening with interest rates and with asset values and prices and with the lending market and all these different things. And so I definitely want to get into it because I think the better that you understand the economy, the better that you understand just markets in general, private and public, the easier it is to make decisions in a way where you can buy assets at a good value or at below value to create cash flow, to create an opportunity to scale your net worth. But more important than net worth is getting utility today and having dollars coming in that you just get to use. So how do you make smart decisions? How do you not lose money? And when times get tough, like I think we're going to head into a pretty rough season. It's like, how do you make money in that? How do you not stay scared or get worried about what's going on? How do you make money in a tough market, or what most people consider a tough market?
Man, there's so many things that we could talk about. And one of the things that we want to do is make sure we leave time at the end just for some Q&A. It could be about the economy. It could be about deals. It could be like, how does Justin find the kind of deals that we have access to, or whatever you want. So we want to give you time at the end to ask questions. But like I said, we could go into all kinds of things, like how to make good investments in a struggling economy. What do we do? Where do we put our money? How much dry powder should we have? Justin and I were talking about multi-unit apartment syndication deals. They've been doing great, but like, how do you know they were stress tested? What kind of stress testing was done, and how will that live up to what we might be going into, and how that might actually be an area where deals might be coming available? So we can do so many things, but Justin, let's just kick it off. You've been in all kinds of economies. You've been an active passive investor. You've been a student of the economy, and you engage with some of the most amazing people. You and I have conversations. I'm like, who were you just talking to? I can't believe it. And you have these conversations that most people will never get to have with these types of people. But I just want to understand, like, what are you seeing? What are you learning out there? We're in a high inflationary bear market. Interest rates are going up, but you're around some of the best and brightest, and you're one of the smartest guys that I know. So, like, what do you see going on?
Well, thanks. Appreciate the kind words. I just love hanging out with people that have a lot of years of wisdom and life on me. So I just, love rubbing elbows with people that are industry experts and whatever the thing is that they're an expert in. And so that's really how I spend most of my time these days. But, we're just in such a crazy time right now because you've got interest rates going up 75 basis points. That's the largest single raise or increase in, about 30 years, almost 30 years, right? Since 1994. You've got 30-year fixed rate mortgages that literally 1 year ago today were at 3%, and right now we're at 6%. So it's like 100% increase. So, you think about like the home that you can buy. A year ago, you could afford twice the home, right? So like, that's incredible to think about. The stock market is in bear territory, as we know, over 25% down year to date right now. The crypto market totally plunged. You had this, issue with Terra Luna and BlockFi and a bunch of other projects and collaborations. You've got Bitcoin down to the lowest it's been in quite some time. You've got a 40-year inflation high, that they're saying is, around 9%, but in reality, it's a lot higher than that. And even their consumer price index doesn't take into account, everything. So like, when you hear the government saying, or the Fed saying that, hey, the CPI is, X, well, that's not even taking into account generally like stuff that's really important to us, like food and energy. And so the numbers are off, the numbers are skewed, right? So like a true CPI is going to be about 4% higher than it is right now. So think 12.5%. That really is, kind of where we're at today. You've got JP Morgan laying off, over 1,000 people. You got a lot of big companies that are laying people off like crazy. You got shutdowns of reliable energy sources. You've got energy shortages. You've got supply chain issues. You've got rapid expansion of monetary supply. You've got just still today crazy EIDL loans that just, they just finished up this last rollout of them. And I mean, I cannot believe some of the dollars that have gone out. I don't even understand how some of these businesses are getting some of the dollars that they're getting. That's just nuts to me. Rising unemployment rates. You've got this one's interesting. You've got the National Home Price Index that is year over year, 20.6% increase. Like, that is just crazy. And we could go on and on and on. But, you know, when I think about like the government, the Fed, what they're doing, like that's the greatest Ponzi scheme of all. You've got manipulation, you know, of government and mortgage bond, you know, just the bond market, the mortgage market, like it's just crazy. You know, it for a long time, the Fed only had control over the overnight rate, but now we're seeing the Fed has control over all rates. So as of 2020, they have control over all rates and the allocation of capital into the economy. So that's just fascinating. You're in a time right now where we had the lowest interest rates in history, therefore the highest US borrowing in history at $2.9 trillion from 2020 to 2021. All right, 2.9 trillion. And then you had the Fed kick in to the mortgage and bond market, $6 trillion. So that's $9 trillion last year. That's just incredible. And so like you think about this, I mean, I could go on and on and on, even with like concerning, alarming numbers. In fact, I'll give you a few other stats and then we can talk about, you know, more investing. But like, I want to kind of balance out what's going on in the world today, because these are things to think about before making decisions on investing. Like, where do you put your net worth? But this one's interesting. So, you know, obviously we see signs of the housing market slowing down. But here's one of the interesting points. So total federal gross interest cost over the last 12 months ending May 31st was $666 billion. And if we included the impending extra interest on treasury bills and maturing notes, the figure actually rises to $863 billion. What's crazy about that is that is more than Medicare spending at $700 billion. It's more than our national military spend, which is one of the highest expenses that our government has. It's $746 billion. So just think about this. Like, where is the federal government going to get money to avoid this, you know, perpetual deficit that they have? Like, you know, is the Treasury just gonna, you know, how are they going to make their interest payments? Are they going to create new taxes? Are they going to lower spending? Like, no way. So where does it happen? They're going to borrow more money. Interesting. So with that kind of setting the stage, that's where you have to say, okay, how do I make decisions in this type of an environment that are good for me, good for my family, with so much uncertainty, with so many different, you know, effects that are, you know, simultaneously being felt.
One of the questions that I get a lot when I'm talking to people about the masterminds is, you know, a lot of people have invested in apartment syndication deals. That's how I got my start in investing years ago. I invested in some apartment syndication deals and they did well for me. And they've done well recently for me. But now there's so many people doing apartment syndication deals. I'm talking to people that are thinking about joining the mastermind, or they're in the mastermind. They've done apartment syndication deals and they want more than that. So like, I don't even know that there's very few of that in the mastermind. The deals that you bring are like way beyond multi-unit apartment syndication deals. So let's just you know, set the stage with that. But I want to talk about apartment syndication deals a little bit, because a lot of people understand those, or they have some type of understanding of them. And I've, like I said, I've been in some, I'm in some currently, but you know, you and I talked about bringing some apartment syndication deals into the mastermind, and you're like, Eric, you like, let's exercise caution here. And you had a list of things of why you thought it wasn't the right timing. And this was before the right timing was kind of cool to talk about with this kind of stuff. So can you give a little insight into like what you think about apartment syndication deals right now? Like, talk about the stress testing and the difference between great deals and great risk adjusted returns.
Yeah, great question, Eric. And I think that we're getting to a day and age where people are a little bit more familiar with the fact that you don't have to invest in a REIT and public equities to make a return or have some sort of allocation to apartment complexes and multifamily. For a long time, I mean, I think the masses had no clue that you could get involved in these on the private side, that there's a syndication where you have a general partner or a GP who would put a deal together and raise money from limited partners. And you could own this property with a third-party management group or an in-house management group, often even an institutional level management group. And so that's kind of this idea of a syndication. And I think it's an incredible place in general to be spending time learning about and to be putting dollars into. But I also think it's really important to recognize that not all syndications are the same. They're not all equal. And, the last really 12 to 15 years, everyone or almost everyone has done well. Like, if you did not do well in the last 12 to 15 years, you really messed up, because it's been hard to lose money in that space. Now, I know people that have, but most people are doing well. But that doesn't mean they're actually good at it. There are a ton of new syndicators in the space that have never been through a recession, that have never experienced what could happen, is likely. I think it's imminent. I don't know when it's going to happen. I just think at some point in time, we're going to feel some sort of an implosion all across the board. Economically, we're going to shake. I think the stock market's going to get a lot worse. I think that the housing market, real estate, I don't know that real estate's going to get hit the way that a lot of the other things are. I think the tech market, the tech market itself is going to be hit pretty hard. I think there are going to be some down rounds in that space, which are going to be ultimately hard to recover from. But like in a syndication, like, you have people that are making money, and just because they did a deal and they turned it around and you got your money out and they did well inside of like one of the best seasons in history to do it, doesn't actually mean that they're good at what they do. It just means that their timing was really good, because some of the numbers that I see people running to where what they have to get in their pro formas to make it work just doesn't work. What we're going to experience here is a lot of syndicators that, instead of getting long-term debt and securing at low interest rates, and their pro formas are going to have much lower interest rates, they did bridge financing. And maybe it's 3 to 5 years where they're trying to add value and then get a better loan, pay off the bridge with long-term financing later, except that they didn't anticipate that interest rates were going to be at 6% right now and maybe climbing, right, according to the Fed. So that is kind of the danger, is like, can they afford new debt? Can they even get it? They might not be able to get it. It may not pencil now. And so deals that looked good and that all the numbers projected looked good, but weren't stress tested with like 7% interest. And by the way, I know someone that literally just closed on a rental property at 7% interest in the last 30 days, right? Like that. Just think about that. Like, that's the new going rate. You can get it a little bit less than that, but that's way different than getting something at 3.5% or 3%. Way different.
What do people do? You might have freaked some people out. There's a lot of good news, guys, coming. There's a lot of good news coming. But let's say someone said, oh my gosh, I just put way too much money. I over allocated into some of these apartment syndication deals. How do they get a level of comfort with that? Or understand the stress test that the GP may have done?
Well, these are all questions that you can ask. When you go to invest, you want to have a lineup. Like, I've got a checklist of questions, and I ask, probably like 50-ish, 20 to 50 questions, where I'm just going down the line and I'm making sure that I'm asking these. And every time I learn something, I meet a new group, my list gets better or stronger. And I also
By the
like
way, with that list, Justin, that what I was talking about earlier, bringing a deal to you to be like, hey, what do we think about this to share with some others? And you ran it through your checklist basically, and it came back with a lot of markups that were just like, hey, this is something that most people wouldn't see or understand or wouldn't pay attention to. And it was a clear no. Like I didn't even question stuff. So, different times, I go back and forth on things and I didn't even question it. I'm like, makes perfect sense to me. But that was after, I ran it through the Justin Donald, due diligence machine.
Well, I think it's just important to have a criteria before you ever make any investments. Like even your own like investor statement, like what are your goals? What are you looking to accomplish? I think most people don't even take the time to figure out what it is that they want. Because if you can figure out, hey, I want to earn a certain amount of cash flow, I want to cover all my expenses or half of my expenses or a quarter of my expenses in passive income. Once you get clear on that, then you'll likely stop making investments into things that don't produce passive income or cash flow in that moment, right? So like you making decisions on what is important to you, what your criteria is, what you're looking for, that helps to make decisions later when you may be more emotional than you are today, or when you made that document, right? Same thing happens with investing. Like I have this criteria of what I look for. And if it doesn't fit the criteria, then it just isn't out. And if it does, then we can move forward. But I don't want to be swayed by the market, with the market, like everyone's buying this, everyone's getting this, like, interest rates are great, whatever it is. Like, I don't want to just go along with the flow. I want to make decisions logically and from a good foundation and a good grounding. Yeah. And not just bidding things up because I want that asset and someone's bidding it up more. And let me just do whatever it takes to get it. That has worked for some people, but that's not a good strategy in general, right? Like, I think you got to have the number where you're like, no, I'm out on this deal at this price point because it exceeds, maybe it's how much I would invest, like not investing more than 10% in any single investment, like not having more than 10% in of your, portfolio in any single place. Right? Maybe too high of a price exceeds that. So I just think it's important to get that. That's not to say that there won't be good multifamily deals. They'll be harder to find with the interest rates where they are today, but you can still find them. They're probably not the ones that have a lot of competition or the ones that are being marketed.
Well, here's something interesting too. And you and I were just talking to one of our smart friends that's a seasoned multi-unit syndicator, knows a ton about all of this stuff. And there's a couple of them. They're like, hey, we've actually been on the sideline for 2 years because a lot of these deals didn't fit our criteria. And they were disciplined enough, which is not easy to do, but they were disciplined enough to say no. And now, like just with what you brought up with, some of these bridge loans may actually, cause some of these that did not have these portfolios very risk, the right risk adjustment on them, or they just went into it not stress testing it enough and just doing the deal because everything's just been going up. So they were saying, hey, if this bridge debt thing is an issue, that might mean great opportunity for us once again, because it will fit into their criteria. And just even for the investor that's not a large multi-unit investor, that might mean there's some opportunities that come up there. So again, like whenever there are people are losing money, there are other people that are going to be stepping right in and making money.
Yeah, there's no doubt about that. We're going to see a lot of, so what you're going to notice, number one, we'll see a lot of deals that are going to die. Someone else is going to scoop them up. They're not going to be able to get the next round of financing that they need. Something's not going to pencil on the deal. It doesn't make sense for them to get the financing. Maybe they would get it, but they can't. Maybe they can get it, but they won't do it. There's going to be deals that come up that, a smart investor is going to be able to scoop up. There's no doubt about that. You're also going to see this from the standpoint of many people that were professionals in this, some of these boom industries. So like housing has just boomed. So mortgage brokers and lenders, you've got realtors. You've got, I mean, the list goes on and on of like all these different industries that crushed it, with people making a ton of money, buying some things that maybe they only bought thinking that income was going to continue the way it is. And so you're going to have those assets fall off, maybe additional homes, maybe nicer cars, and other, purchases or material possessions, some being assets. Some, I don't know that you would actually qualify them as assets, but there's going to be discounted acquisitions to come for sure.
I want to ask you, you're part of Tiger 21, which is a group that you pay to be a part of, because we both pay to be a part of different groups. Tiger 21, I think the minimum net worth right now to be a part of that is 20 million, and you have to get accepted, and it's a pretty amazing group. And there's a lot of information sharing that goes back and forth in that group. And in just a second, I want you to talk about just what you have noticed in that group about asset allocation, because everyone, some of the people that I talk to that are looking at joining the mastermind, they are probably over allocated in the stock market compared to the higher net worth individuals out there. So I want you to talk about that in just a second. But also, I think people always wonder, like, what kind of deals do you have? Like in the mastermind, there's a lot of different deals. There's a lot of different deal flow. Some of it comes directly from you. Some of it is from the community. It's an amazing, but I'll say this, there's like no hurting for deal flow. Would you mind, I haven't asked you this, and we can talk about generics about a different deal. But there was a deal that was posted in the Circle group not too long ago that was like, hey, there's this cool thing. There's need X amount of money to buy this property, and the comps are amazing, and it's just in this great area. Here's an opportunity for someone to deploy some cash for a period of time. Do you want to talk about like that deal structure, or do you want to talk about a different deal structure? You pick, buddy.
Yeah, no, I can definitely talk about that one. Now that it's done, now that it's closed. But to answer your first question, one of the interesting things is when you look at Tiger 21 as a whole, so you've got 1,100 members, a little over 1,100, most of them in the United States. There are some bigger cities that have some locations like London and Geneva, but it is predominantly in the US. And these are some of the smartest, most sophisticated people, double digits of billionaires. The median income in the group, I think their median is close to 100 million. So it's a pretty fascinating group of people. And so one of the things that we do every year, and so I've been able to look at these for about the last 5 years, is kind of break down the portfolios that people have. And so you get to see, as a whole, where are people allocating their capital? What does their portfolio look like? And so some of these may be surprising to you, but inside of Tiger 21, generally it's anywhere from 25 to 33% of their portfolio is in real estate. Generally about 25% of their portfolio is in private equity, and that sometimes floats up to about 30%, so 25 to 30%. Generally for public equities, it's 22 to 25%. And so right now, I think it's either right at 25 or it's at 24. And then, everything else. So, about 25% or a little bit less in everything else. And so we could say crypto, gold, cash, debt. And when I say debt, like as an investment, like senior secured debt or collateralized or unsecured debt, like hard money loans that are out, that type of stuff. And if you also pay attention to like family offices, which are the organizations that basically invest money for the wealthiest people across the US, you'll learn and you'll realize that really most of the money that's in the public equities really is people don't make their money generally by being in the stock market. They maintain their wealth by being in the stock market. So most people make their money and then have a portion of it that is in public equities. what I experience when I meet people and kind of learn what their investment strategies look like, what their investment history looks like, what I often see is that they're over allocated to the stock market. They might have 90, 95, even 100% of their net worth outside of their business if they're an entrepreneur. And, if they are not an entrepreneur, I mean, it's really close to the vast majority inside of kind of one vehicle. And maybe it's diversified, but that's still a tremendous amount of risk. So if you take a look at the wealthiest families in the world, specifically in the United States, let's just call it 25% private equity, 25% public equity, 25% real estate, give or take, and then 25% everything else. So I think it's important to recognize that you don't want to have too much in any of those areas. You don't want to be 100% real estate. You don't want to be 100%, public equity. Maybe you have a company and you don't want the only place that your net worth resides to be there, because if it goes under, you lose everything. Like, it's really important to spread that out. And I think the best way to do that is to copy the wealthiest people that I think have it figured out. And, to kind of follow on, you had asked, hey, tell everyone about the deal that you
let's hold off on that deal,
right,
because we can absolutely talk about that deal. I want to get to some Q&A here sooner than later too. So that comes up in the Q&A, that's fine. I want to shift gears just a little bit right now to talk about what you can and what you should do now. Like, this is about you. We want to give you value on what we see, what people should be doing now or could be doing now. And Justin, one of the things that I've heard you, mention before is like building a layered waterfall of returns with the same capital. So there's a few different points I want to hit now, but either hit that one or hit tax structure.
Perfect. Can you hear me? All right. So here's kind of the way that I look at it. So I really want to build cash flow. I think cash flow is important. I think until you have cash flow to cover at least your survival income, that's like top priority. How do we cover the cost just to survive? Maybe not to cover your current lifestyle, but for me, I started with survival, then I went to current lifestyle, and then kind of went beyond that. And I just think it's important to be focused on assets that will produce cash flow, but then they're recession proof or there's low risk. So to me, there are still plenty of places that you can do it, but it's more about what's the price you're getting in at. So are there investments that are, very friendly via tax code, like the government is incentivizing you to do things such as affordable housing, agriculture, renewable energy, solar specifically. I mean, the list goes on and on. If you study the tax code or talk to people that know it, of where the biggest discounts and tax reductions are. But I think, like, even in this world of real estate, you could buy something that's way overvalued, or you could buy something that's way undervalued. And the deal that we just did, we bought land Springs. Well, I don't know that I want to buy it. And that's like, outside of Austin, a very popular hot spot. I don't know that I want to buy, land and real estate at the peak of the market. But if I can get it under price, which we were able to do, the going rate, the comps that we got on the appraisal were $150,000 an acre, and the neighbor property just sold for $190,000 an acre, and we bought it for $47,000 an acre, which is just incredible. So like, that one's a no-brainer. You're not going to lose. It's really hard to lose money at that basis. Like, anyone that knows the Austin market would give an arm and a leg to get in on that deal. So we closed that deal today, and we got an offer on that deal for $2 million more. We bought it for $6 million. Got an offer for $8 million the day that we closed. So we could lock in a $2 million profit today. We're not going to, because we think the upside is tremendous. We actually think the upside is, that we'll probably profit. We'll probably double and potentially even get a 2.5 x multiple in 2 years. So those exist. How did we find that? It was an invisible deal. It was a mom and pop. They had a number that they wanted, and it was that. Like, so you tie it up, you put it under contract. I've got a mobile home park under contract right now. I still like mobile home parks. I think it's an incredible space. There is scarcity in the space because there are only 44,000 mobile home parks in the US, and about 100 get redeveloped every year. So it's hard to build them. So it's a dwindling number, and it's affordable housing. So there's advantages via the tax code. And if you buy right, they generate cash flow today. So I still like that. There's tons of other opportunities too, but those are just a couple to name. And again, there are mobile home parks that are awful deals right now. There are deals in, Dripping Springs that are awful deals right now. So it's not that anything in that category is good. It's that the right price stuff's out there, and you got to search for it. You got to hunt. And you've got to be disciplined to know what your criteria is when you want to invest, and not compromise what you wanted to do because maybe things changed or the economics of the deal changed. You really have to honor the criteria that you set up ahead of time that is supporting the values that you have or the lifestyle that you want to live.
One of the things that I've noticed in the groups is the brain trust that's in there. I mean, you are incredibly talented. Like I said, one of the smartest guys that I know when it comes to passive investing. You've got your own plan of due diligence, but I know I've seen it, I've experienced it, pulling on other members in the group, the community to look at deals, to get their expert eyes on different things. So different people are experts in different areas. Some of us are in franchising or multifamily or, technology, private equity, all kinds of different stuff, looking at deals with, promissory notes, with equity kickers or warrants, or all these different kinds of things and different types of waterfall structures on different deals. And some of them are great and some of them are not so great. Who gets paid first? So there's so many things that are tied into due diligence and just getting a set of eyeballs on these different deals. So that's one of the things that I love about community, because when people think community, and guys, we're talking about the community and the mastermind right now, but you need to be doing this in your local community to start to get to know some of these people that just think differently than you, that have different experience than you. But in the mastermind, due diligence and community kind of go hand in hand with me. Any comments on due diligence or community? Because that is probably one of the better benefits of being a part of any group like this, but it's a huge benefit. And I know people have saved a lot of money by not going into certain deals.
Yeah, I think your peer group's everything, right? So the people that influence you most are the ones that you spend the most time with. And so I think it's important that you be strategic with who those people are, that they're people that bring you energy, that make you feel good about yourself, that are smarter than you in certain areas where you can be a student of their expertise, people that you just really enjoy. So yeah, I think that's important. That doesn't have to be here, but it should be somewhere. Like, be intentional with who you're spending time with so that you can have smart people help you make smarter decisions. I can assure you that I make way better decisions today than what I ever made on my own, because I have other smart people to bounce answers, bounce questions, bounce theories off of. And I think when you have, a contingent of several very smart, very sophisticated, even high-level experts in different areas, it's going to be harder to make big mistakes. So like what you want to do is you want to avoid, one, losing money, making a big mistake. Number two, you want good deals. You want to make good decisions. Number three, I think you want to have some incredible tax strategy. So like, how do you create money out of thin air? Well, that's with good tax planning. Number four, I think you want an incredible
Dustin, you just hit on that. So like that whole thing, we could go down for hours and hours and hours. Just give a little bit more on tax strategy, tax planning, because I know people in the group that had things set up from really smart people, and yet they had a few little things tweaked or wrong with it that really didn't make it as efficient as it could be in terms of tax strategy. And they tweaked a few things and or changed some things, and their whole ability to save money, to have more investable dollars, changed.
Yeah, I think that if you question whether you have a great CPA or not, that means you probably need a new CPA. Like, you should know that your CPA is incredible. And by the way, if you don't have a CPA, you should probably get a CPA. Like, if you just have, a tax professional, like, get a CPA, get the highest ranking person. Whoever you use should save you more than it costs you to use them. So in our group, we have people that are saving tens of thousands to hundreds of thousands to a whole bunch of people are saving millions, and in some cases tens of millions. A great quality. So there's kind of two tiers. You got a tax professional who will file stuff. You got a tax strategist who will help you create some of the frameworks. Sometimes they can be one team, one office, one organization that has depth. Often it's two different people that work together, and they're not in the same organization. And so I just think that you want to get to a point where you're like, the number one way to make more money is not to have a good investment. It's to actually pay less in taxes. Like, you make more money than that, doing that, than anything else. And then you want to have good investments. But the goal is not to get the biggest return. The goal is to not lose your money. So if that means you don't get as good of a return, that's okay. And how do you accomplish those? You need to surround yourself with people that are great at those things, that are experts, that are smarter than you. My goal is to be always hanging out with people that play the game of life and business and investing at a higher level than me, because I want to learn. I want to be a student of whoever's the brightest and best in class.
I think we've got some questions, so I want to get to that. Like I said, we can always talk about that deal, about that whole tax strategy, the tax savings. We have a lot of different recordings on that in the masterminds, and like, that's, I think, one of the biggest surprises. You talked about a guy that saved, many, many millions, and I've had private conversations with him, and he's just like, Eric, I had no idea. Here this guy is that has a significant net worth. Significant. And he's like, Eric, I had no idea this stuff. I have smart people around me. I've made a lot of investments, but I had no idea this stuff was available. And it's like changed. He said there's two significant times in his life that were like so impactful to him, and that was one of them. And that says a lot. All right, we got some questions. Justin, do you want me to ask you? Do you see my buddy Gil? So Gil's been a buddy for a long time. We just reconnected recently. So he said, how do you shift from fully invested in the stock market, think 401k here, to limit your downside into these alternative investments?
Well, Gil, that's a great question. And again, it's not to say that you totally exit out of the stock market. Long term, I'm still a believer in the US economy. I'm just not a believer that all my assets should be there, and that when I want to retire, it's actually going to be a great economy. Right. So I'm hedging against that. And so I think you start, small and you start with an education. I think that is what I would do. I wouldn't rush it. Like, the goal isn't how do you take as much out as you can and how do you place it as quickly as you can. That's not the goal. The goal is how do you educate yourself to the point that you're making good decisions where you can get a return, hopefully even some cash flow, while also diversifying your portfolio. So this one to me is just start one deal at a time, right? You don't have to make huge decisions. You don't have to change your entire strategy. I would probably get clear on what you want it to look like, but just start one deal at a time and figure out what the amount is that you feel like you would want to invest. You don't want to put too much in any single deal. I don't want to put more than 10% in any single deal of my net worth. I think that is kind of a line that I don't want to cross. And a lot of people think it's 5%, right? Now, for me, I'm an expert in a specific niche. So I Like I know mobile home parks better than I know anything else. So I have more than 10% of my net worth in mobile home parks, but that's because that is my bread and butter. But I also have a lot of knowledge and sophistication in other real estate, and I do a lot of other real estate, and I do, you know, I invest in cannabis and hemp and CBD in the right, you know, environments. I have senior secured debt. I have, you know, technology, SaaS specifically, enterprise level, ideally. You know, I invest in, I mean, the list goes on and on. And so you don't have to do everything all at once. Like I like music royalties. I like original content. I like, I mean, there's so many things, right? I like hard money lending to a certain degree. With a percentage of my portfolio. But I think what you do is you find a good deal, you find a safer deal. Maybe you know real estate, or maybe that's a good starting point. For me, that's how I started, by doing one deal. So that's what I'd encourage.
I was laughing because you started listing off all these things, and we're just scratching the surface on the kind. People are like, I didn't even realize this was actually in an asset class or a subset of certain asset classes. Before I get to the next question, there's a private question that came through. Do you provide referrals for tax professionals to mastermind members? Justin, you want to take that? Like, what do our network, like it becomes their network basically?
Of course. Yeah. I mean, the goal is to share every professional under the sun that is the best in class. And moreover than just sharing the connection, we want to educate. So we take the best and the brightest and we have them, you know, share. Like Tom Wheelwright, you know, is Robert Kiyosaki, Rich Dad, Poor Dad author. It's his CPA, and he teaches you know, at our, you know, events, which is really cool, and other, you know, very smart, sophisticated people also.
We've got more questions coming in, public and private to me. I want to put in, a lot of you guys have already applied for the mastermind. I'm just going to simply have Caleb put in a link to the mastermind application. If you want to fill that out, if you're interested in the mastermind, you know, feel free to fill that out. And you'll be in touch with myself or someone on our team, and then we can start that process. But hopefully you found this type of Zoom meeting helpful. So Justin, anything to add to that before we get to some more questions?
Well, I want to make sure that we don't miss any questions. And I think, you know, timing's everything. So if now is a good time, I think it's great to take advantage. But if now is not a good time, that's okay. Like build your group, your network, your brain trust, like find super successful people that have done the thing you want to do. Don't get coached by people that haven't done the thing that you want to do. Find people that are living exactly what it is that you want to live and have the expertise and the experience doing the thing that you want. And that's where you kind of grow your network and your peer group. You know, with Terry, I just want to make sure, you know, Terry, all land leases are different. So my recommendation, by the way, I love land leases if structured the right way. I think they can be incredible. So I'd say yes, but have someone who knows that space make sure that these are airtight, you know, that you're buying at the right price, that your lease is solid, that, I mean, these could be killer because you have other people build the infrastructure on it and then you own it when the term is done. So yeah, tons of cool stuff. You know, and Amber, I just want to get back to you real quick on how do you see the rise in interest rates affecting the availability and quality of debt? Yeah, of debt deals. Yes, it impacts it. It can impact it negatively and positively because it weeds a lot of people out, weeds a lot of bad deals out. But there is no doubt that you'll have less people in looking to make investments when time gets tough. So there are going to be great opportunities, but then there are less good deals because in order to make it work, you know, higher interest rates are just tougher. So it's, you know, there's a little bit of a chicken and egg there, but I'd say pros and cons of that scenario.
And Derek, then I realized just now that I went down to the bottom of the list instead of going top down. But Adam had a question too. And by the way, if you do fill out that application, you can ask some questions in there so we can get to some of those because we'd like to know kind of what people's questions are. So if you do fill out an application, make sure you put some of those questions that you have in that application. But Adam had a good question, really good question. How do you balance between like planning for dry powder for some of these deals, and then just like, how do you have enough dry powder? How do you not have too much? And when deals come up, so you can pounce on them.
Adam, this is the $1 million question, my friend.
And to do that, you absolutely have to join the mastermind, because we won't deny teasing.
Well, you know, Adam, I love this question because what's the right amount? Who knows? Like, you know, I was just sharing this, that I thought that we might see a little more turbulence before what we have. And I've seen some, and we've gotten some good deals, but I had thought that it might be a little bit like just way more exciting deals right now. But if I had been holding on to my dry powder, waiting for these awesome deals, I would have missed out on a bunch of the deals that I did do. But I have this really funny relationship with money, in the fact that, like, in my mind, it's like, I want to wait for a good deal. Like, I want to get a real good return on this. So let's wait 6 months and see what happens. But what if that good deal comes tomorrow, right? So I want to be open to evaluating it. So in theory, I want to have a lot of dry powder, but I don't want to pass on the deals to have the tail wag the dog of having dry powder when the deal is right there, even though maybe it's sooner than the cascading effect of even better deals or even more deals, right? Like, the moment I got a good deal and it's invisible and there's not a lot of competition, I would like to strike.
I like it. All right. Continuing on with some of these questions, my buddy Solomon, shout out to him. He's a new franchisor. But like, how much how much is devoted to like deal flow, education? Like, give us a sense of the mastermind in terms of time allocation to what we talk about. And then, yeah, deal flow, education, average check size, different things like that.
Well, the goal is to be educating and giving opportunities to get into deals. So it is a combination of both. I mean, I want to say it's probably 50-50, 50% focused on education and then 50% on deal flow. But I don't want to do deals just for the sake of doing deals. So I don't want to have that be like a hard number, because what if we enter into a season where deal flow isn't as good? I don't want to just present deals for the sake of keeping that. I want to present good deals, period. So if they dry up, then that means more education. But sometimes what's fun is to look at a deal that's not a good deal and figure out why it's not a good deal. So I think that most people think that what they want is deal flow. But what they realize is that the greater value is the community of members and in the education that they learn today, but they can use 10, 20, 30, 40 years down the road. So the deals often are what get people interested or get them in, or this allure of like, ooh, I want some passive income. So often people think that's why I want to be here. But if you interview anyone in the mastermind after the fact, almost like maybe 1% of them are going to say that was the greatest value. Most of them are like, the network's incredible, the tax savings is unbelievable, the education is just nonstop.
I want to hit on one thing. The reason that you started the mastermind to begin with, like the way that you structured it, was to be different than most financial institutions, most ways people invest, and to provide honesty, clarity, like that, you know, you just did it so different, Justin. And I've had so many people reach out to me and say, people that I've talked to about the mastermind that are peers. And they've said, why did you structure this way? You could have made way more money, you guys, if it was structured differently. And I've heard you say it, Justin, on these calls. You're like, no, we did it this way on purpose, and this is why. So can you hit on that a little bit? Because I think it's really important and probably not said strong enough.
Yeah, you know, this is an interesting thought. I have not really spent time as, you know, a professional in the financial services industry. So the way that I look at everything is going to be a little bit different. And so in financial services, basically you make money on other people's money. And I don't like that model. I think that's a broken model. I think it's totally flawed. I don't think that when you lose money in the stock market, your financial advisor should make money. I think that's horrible. I think that's a horrible design. And I also think that most financial advisors recommend the highest commission products that they themselves don't invest in, but they know they're going to make more with those products. So, and then like even on the private side, everyone's making a carry or carried interest. So they make a percentage of the whole pie that they raise. And while I don't think that there's anything wrong with that, again, depending on the way it's structured and depending on the splits, it's often not investor friendly. It can be investor friendly, but it's often not. So my goal is, how do I create something that just has like a flat tuition, and then I'm not making money on anyone else's money. I make money on my own money. So if I invest, I make money on those dollars. I don't make money on anyone else in the mastermind. So that way my alignment is spot on from day one. So when I, share that I like something or here's what I learned, people can recognize that I'm sharing it, knowing that my own money is going into it and I'm not making money on their money if they come into it. And so they can make the decision. Whether someone chooses to invest or not, that's up to them. But I think one of the most unique things from what I hear, people are like, you're crazy, you should make a carry on all this stuff. And by the way, there are some deals where maybe I will, but not inside the confines of the mastermind, because this is the one place that people can go where they know that I don't make money on their money. There's nowhere else that this happens in the financial industry as a general rule.
All right, we're going to wrap it up. I'm going to hit on a couple of the questions, then I'll kick it over to you, Justin, for some closing thoughts. Someone asked about this deal flow in the mastermind. I'll say this. I've never heard anybody in the mastermind saying, I wish we had more deals. I have heard people in the mastermind that have a ton of deal flow. Like, I can't believe how much deal flow Justin actually has. It's amazing. I've never seen it before. So we can get specifics if you want. We can absolutely do that, but nobody's ever accused Justin, us, of running out of deal flow. It just won't happen. That I've seen. Highlights of the structure. There's Zoom meetings, there's master classes with experts, there's time with mastermind members, and there'll be, is it fair enough to say, Justin, there'll be one conference a year? Yeah. That's not promised, but it has happened. I think that's probably the best, because COVID happened and it shut everything down. So that's not a promise, but that's something that's historically been done, even as we've gone through this crazy time with COVID. So there's just so much given. But Justin, closing thoughts.
Yeah. Oh, I mean, there's one last question or a couple that didn't get answered. And I just want to, make sure that I share. So investment sizes are across the board. Some, are 25,000 minimum. Some are 50,000 minimum. Some are 100,000 minimum. Sometimes we can even get people to do investment groups together, like as an LLC, and they can put in 10. 3 people put in 10. So the amounts are different, but I think more important than the deal flow is the education and the people that you spend time with. So again, my biggest thing is find people that you aspire to be like them, that you want to learn the things that they learn, that you want to be in proximity with, so that you can play the game of life or business or investing at the level that they're playing it, and make your move to get into proximity. So that may be this, mastermind. It may be someone else's mastermind. But maybe it's your own, but whatever it is, I think that you want a community of like-minded people that stretch you out of your comfort zone and allow you to play the game of life bigger than what you would without them.
Love it. All right. You can apply there if you want. If not, make sure you listen to Justin's podcast, The Lifestyle Investor. He did a live one with Tai Lopez a little bit ago. That was fun. I was in the room on that. Get his book if you don't have it already. Hit us both up on social media. Jump into my Facebook group, Franchise Secrets. Just get into our worlds. Get on Justin's newsletter. We just have a lot of fun. So we're all about giving value, and we thought we'd jump in here and do a live meeting with all of you. So thank you for taking an hour out of your day to hang out with us.
Thank you. I hope you had fun. I hope you learned something, and yeah, it'll be fun seeing the waves and what happens in the future. This could be a defining moment for the future. So I'm excited. I'm excited for what is to come.
Thanks, everyone.
Awesome. Thank you. Happy 4th.
Happy 4th for
4th.
sure. It's gonna
Thanks,
be
guys.
a
That's fun.
fun one. Man, I see a lot of people reaching out. Cool. Looking forward to talking to some of you guys. See ya.
Thank you. Bye, guys.